Hello, everyone. Welcome to Lecture 9 of Quantitative Trading Strategies. In this lecture, we're going to talk about forward and futures contracts. So let's get started. So both forward and futures contracts are derivative products, meaning they are derived from some underlying products, which is also called underlying. They obligate the buyer to buy a predetermined quantity of an underlying asset as the predetermined delivery dates and price. So quantity gives us the size of the order or order size, and we can control the delivery dates or transaction dates and the price of the transaction. So that's the flexibility we have. So both contracts allow us to eliminate the uncertainty in the future price, in the price of the in the future for the assets. Now there are two types of traders that enter into the futures or forward contract. Mostly will be to hedge the risk of big changes in price, but also we have speculators to speculate on the future movement of the asset price. Futures contracts are traded through decentralized futures exchanges, and the exchanges serve as the middlemen that interpose themselves in the middle of the transaction. And the main purpose is to one is to provide liquidity to the market, but also to eliminate the counterparty risk, which means that the opposing party of the transaction may fail to fulfill the obligation of completing the transaction. So the counterparty risk exists in the forward contract agreements, which are usually transactions over the counter and between two parties directly. So the two parties would set the terms for the agreements directly with each other. So futures contract profits by futures exchanges profits by maintaining a spread between the quoted price from the buyer and the seller. So on the one hand, they establish a contract with a buyer, and when on the other side, they establish a contract with another seller, right? And they add small margin on the price and the prices of this with these two parties. So any party who would like to engage a contract, futures contracts with the futures exchanges will need to open and maintain a margin account. So this serves as an insurance account in case the price of the underlying assets move against the exchange, which means the price may drop in value. Therefore, the asset becomes less valuable, and they would require the buyer or the seller to top up the margin accounts if that's the case. So futures contract it is a derivative product because it depends on another underlying assets or underlying. So it could be physical assets such as grain, livestock, energy, or non-physical contracts for assets such as currency or even securities. So every futures contract is tradable, meaning you can trade futures contracts on the markets just like a stock. So it is possible to exit futures contracts at any point in time before the delivery date. And most people do that for hedging purpose. Let us look at the parameters of a futures contract. We have three parameters here. The lot size specifies the quantity, the size of the order in the underlying assets that will be traded. So it is a predetermined multiple of the minimum quantity, which means that if I want to trade one futures contract and each future contract corresponds to 100 stocks. Then in total, I can trade 100 stocks using one futures contract. And therefore, we can calculate the contract value, which is the total value of the futures contract in terms of the underlying assets. The calculation is just the multiplication of the two in terms of the lot size, how many want to purchase or sell the underlying assets, and for each asset, what is the price? So for example, in the previous example, if one futures contract corresponds to 100 stocks and the stock price is 100, then one futures contract would correspond to 10,000 in the asset value. We also have a margin, which means the amount of deposits from the investor to enter a futures contract position. So this is the initial margin. And we also would perform the so-called daily settlement, which means every day we'd check the asset price and make certain adjustments to the margin account. So if the amounts in the margin account falls below thresholds specified by the maintenance margin, right? So this is a threshold, then the investors would get a margin call to top up the margin account. So that goes back to the initial margin. And we also have the expiration dates, which means the dates of the actual delivery for the futures contract. So it could be not necessarily physical delivery, it could also be cash settlement. So physical delivery means that the buyer who enters the contract in the long position of the futures contract will pay the agreed upon price to the seller. We will in turn deliver the underlying assets to the buyer on the predetermined date, which is also called a settlement date. So if the delivery is in the form of cash settlement, then what happens is the net cash position of the contract being transferred between the two parties. Right? This is mainly due to the mark-to-market exercise by the futures exchange, which I'll talk about later. So most derivatives are not exercised upon the settlement dates. They are mostly traded out before the settlement dates. So trading out meaning they will sell the futures contract and enter into another futures contract on a rolling basis. So let's talk about the clearinghouse. So this is an intermediary between a buyer and a seller in the financial markets. And they are there to guarantee that the transactions happen as planned, right? So each party in the transaction would honor their obligations, and thus eliminates the potential counterparty risk. And they do this by specifying a margin requirement. So meaning each party would need to open a margin account and satisfy the minimum maintenance margin threshold. So if it falls below the threshold, then they will get a margin call to top up the remaining balance. Right? So this is again because of the fluctuations in the asset price on a daily basis. Graphically, we have the clearinghouse here, and the buyer would receive the goods and then puts the funds to the clearinghouse, and then the funds again would go to the seller. Now, this is not the same amount because the clearinghouse would add a small margin, right? And the seller would deliver the goods to the clearinghouse and to the buyer. So this is the illustration of the role of clearinghouse in the transactions. All right, so that's it for this video. Thanks for watching.